Hello, everyone. Welcome to our discussion of Chapter 3 in our textbook. This is part 1, and we're going to spend our time talking about things that are included in our gross income. Remember, our tax, you might say, formula starts with gross income, things that are included. And this is what we're going to talk about here first. And then in part 2, we'll talk about what is excluded. Now, the general idea, really, on the tax law is that everything is included in gross income unless specifically excluded by law. So if there's ever a question with no statutory, no rules, no law that's been passed about it. If it could be termed income, it is probably to be included in gross income. That is our default, if you will. All right. So to count as income, though, it must be realized and earned. We must do something for it. Okay. But basically, when you think about it, and realize just means received. We have to receive something. It doesn't even have to be cash. Okay. But generally, it's going to be in the form of cash or something similar. But that is not necessarily a requirement. Anything that would make us better off could be considered to be income, that there's been some sort of exchange, we've received an economic benefit, and of course, if it's going to be included in gross income, it wouldn't be tax exempt, meaning it hasn't been specifically excluded under the tax law. So basically, we start with this all-inclusive thing, and then we'll talk a little bit about how that's measured, and some things you may not think about and realize, and then we will look at the exclusions, the things that are specifically in the law to exclude from our income, even though they might fit this definition. Okay, typically, all taxpayers, individuals at least, use what's called the cash basis of accounting for tax purposes, meaning they receive income when they receive the cash or cash equivalent. So it doesn't necessarily have to be in the form of cash, but it's the equivalent of receiving cash. You have to receive something. It can't just be the promise of receiving something in the future. And you get only deductions when you make payment, not when you promise to make payment. Now, we'll talk a little bit about it in Chapter 6 that in business expenses, you can use your credit card, count the expense when you use the credit card, even though you technically do not pay for that until a later time, just to simplify our accounting purposes rather than having to keep track of what we've paid for and what we haven't. Okay, so almost everybody by default, you use the cash receipts and disbursements method that you didn't know, but your first tax return you ever filed, when you filed it the normal way without asking for something different, you chose to use the cash receipts and disbursements. It would be very difficult for an individual, especially one that's employed by someone receiving a W-2, to use anything other than the cash receipts, because the W-2 that you get from your employer uses the cash receipts. It is the amount of money that you were paid and received, not when you earned it. So, for instance, if you worked the last week of December but you weren't paid till January, that's on the W-2 for the next year, not for the year in which the December fell. Okay, so we have this little concept that kind of helps clarify cash receipts and disbursements in kind of odd cases. Receives the right to control the income rather than the year in which it is earned. Here's the here's the constructive receipt. If I write you a check for the work you've done, and I call you up on December 27th and say to you, I have a check here, and I live right down the street from you. I don't live on the other side of the country. I have a check from you. Run by and pick it up anytime you'd like. And you say, okay, I'll wait till after January 1st to pick that up so that I don't have to report it on my taxes for the last year. I can report it in the next year. That would not work because you would have constructive receipt. The point is you could have picked it up anytime you were in control of that situation. Okay? Now that seems a little bit odd, but that's the example we always use to illustrate the concept. Most people don't, it would be very hard for the IRS to dispute when you actually did it. Point is, if you want to postpone income till January, you need to not send the bill to your client so that they don't write you a check. Because if the check is dated December, you're going to have a hard time arguing with the IRS that you really didn't get it till January, especially if it wasn't a long distance situation. Okay, but also receipt of property. Again, the receipt of the property or services will trigger income recognition. So I say, I'm going to do something for you. When you do something for me, that the fact that each of those received would have income on both sides. So that is, it doesn't have to be in the form of cash. Okay. So a couple of review questions. Income may be released in form, whether money, property, or services. True. So if your employer sends you on a trip, that is income. If that was a reward for getting a certain sales goal and they send you off on a vacation, that is income. Then it wasn't in the form of money, it was in the form of trip. I don't care if they pay you in jelly beans. Okay? They decide instead of paying you cash to pay you in jelly beans or provide you with a car or any of those things. Those all can be would be looked at as income unless specifically excluded. We'll see a couple of instances of that. Okay. Second one is probably a little more tricky. Okay. You do work for your friend does work for you. Both of that, you have income based on the value of your services. Both. So if those repair services and consulting services were worth $1,000, then each of you has $1,000 of income. Of course, then you can also offset it with any expenses you might have. But that's your gross income. It's included in your gross income. So some specific examples of things that are included. First of all, talk about interest. That's one that's listed specifically on the 1040. Okay, so think through all the ways that you could earn interest: banks, savings and loan, credit union. You're going to get a report. You're going to get a 1099 INT from those institutions for the most part, unless it's less than $10. They actually exempted them. Some will still send it to you if it's under 10, but they don't have to. So and IRS isn't going to care if you don't report the $10, the $9 of interest or whatever. Obviously, not a big deal. Savings bonds, you've heard of them. Those are specific series. Okay, that savings bonds, and that earns interest over time. And then basically you give it to somebody that you pay $50, you give them that savings bond, and they hold it for a while. When they get to be 15 years from now, it usually matures. You take it in and redeem it, and you get $100 or whatever the amount is. You have a choice. You can either report that a little bit each year as it grows, or at the maturity when you redeem it and get all 50. Okay, and then here's the exception. Specifically in the tax law says that interest on states, cities, counties, school districts, those are considered tax exempt. Those are, so if you have a earn interest by loaning money to one of those entities by buying those bonds, then that interest would be tax exempt. Now, it is not a blanket thing. There are some exceptions to that exception. When the government issues bonds and then takes those bonds and builds a football stadium, that is a commercial enterprise, and therefore the interest on those bonds would not be tax exempt, or at least only be partially tax exempt. So that's a little more complicated. One situation we won't run into very much. Basically, the assumption is if it is issued by a governmental entity other than the U.S. government, that it is tax exempt. It is excluded by law from being included in your gross income. So some things you might forget about or might not think about in terms of interest. If someone were to sell their house and instead of the person getting a loan, they actually just pay the seller off over time. That's a seller financed mortgage. That would be interest income to that seller. Okay. Anything that you buy over time, installment sales, or there's interest involved. Imputed interest on loans made below market interest rate. I give a loan to my friend or something at zero interest, even though the rate should be 5%, I still have 5% interest that could be included in my income. We don't believe in zero interest rate loans from the IRS standpoint. Okay, and then some things about buying and selling bonds in between interest dates. If you have interest over $1,500, you must file a Schedule B of Form 1040. That is a list of who paid you interest and how much, so that we can trace it back to the actual documents. If it's less than that, you could always file the form. You can even put the stuff on the form, but it is not required to be actually sent into the IRS, or they're not going to ding you if you don't do it. All right, dividends. That's the next one that's listed specifically on the 1040. Okay, so dividends are paid out by corporations out of their earnings, distributions to shareholders. So there's two types of dividends. There's regular dividends and qualified dividends. To be qualified, they have to come out of the earnings and profits of the corporation, which is generally what they are. Okay, but it has to be a domestic corporation or a qualified foreign corporation. So most foreign corporations are not qualified, and therefore it's typically only if you get dividends from like a single company, like for instance, if you had Microsoft stock and they paid you dividends, or Apple, that would be qualified dividends. Many people own what's called mutual funds. Those pay dividends. Those are not qualified because they do not come from a specific corporation. So that's the most common differentiation. Now, the point here, dividends are always included in gross income, regardless of what kind they are. Regular dividends, qualified dividends, but okay, and your total dividends are always going to be more than your qualified dividends, right? You can't have more qualified dividends than you have total dividends. Okay, qualified dividends is a smaller subset than the total dividends. Back in 2017, we set up a different set of tax brackets for qualified dividends. This is only qualified dividends. They're still included in gross income, but this first one is kind of key. For married filing jointly with taxable income of $94,000, or head of house is less than 63 or under 47, the dividends are taxed at zero. So your tax may be zero, but they're still part of your gross income. So Please keep that in mind because you're going to face some questions about that sort of thing in your work, in the exams, where you may, depending on what you're asking. If you're being asked what is your adjusted gross income, you need to include this. But when you are calculating your tax liability, you're going to exclude it if your income is that low. Okay. However, there is a tax rate from over those amounts up to this huge amount, okay, of 15%, and you only are paying 20% on the qualified dividends if your incomes are over these three thresholds, which are very high and quite a bit of income, only apply to a very small percentage of our population. So you pay a different rate of tax on your income that comes in the form of qualified dividends, not regular dividends, but qualified dividends. So it's very important to know whether it is a qualified dividend and to be able to separate it out from our other income when it comes time to calculate our tax liability. Okay. Stock dividends, you sometimes will hear a word about, and stock splits are not taxable because you do not receive any cash. That was determined by Supreme Court many years ago, that stock dividends did not constitute any income, no actual benefit to the shareholders. Dividends, just like interest over $1,500, you got to use Schedule B. So the top part of the Schedule B is interest, bottom part of the Schedule B is dividends. All right, some other pieces of gross income. Refund from the state and local governments. You get a refund on your state income taxes. Okay, now this is a little tricky. Now in Pennsylvania, this happens mostly rarely because our income taxes are so straightforward that most everybody has exactly withheld what they need to pay in because there's very little complexity. But other places that may not be the case. So you may get a refund of income of local income taxes, state income taxes you paid in the previous year. If you got to itemize the amount the year previous, then you have got taxable income. You need to include the refund in your income, at least to the point that it made your deduction higher than your standard deduction. And that's the key. If it may, to the extent that your itemized deduction was higher than your standard deduction. So it might not, even if you itemize the previous year, it might not actually be the full amount of your tax refund because it may not have exceeded the standard deduction by amount of the taxes. So there's a kind of a cool formula in your textbook about calculating that. Remember that when it comes to refunds of state and local governments. If you're in a situation on the test or in homework or whatever where it's unclear whether they itemized the previous year, please just assume if they're itemizing in the current year, they itemize in the year previous. And that's kind of the way we do it in real life. Okay? And then we can always go back and look at what it is, but our first thought is if they're itemizing this year, meaning their itemized deductions are higher than their standard, then that's probably what happened the year before. Okay? So there's how you calculate lesser of the amount received, the amount deducted on Schedule A, or the amount by which the itemized deductions exceed the standard deduction. Okay, it's not quite as complicated as that seems, but there is a homework problem that will ask you to apply that little concept. Social Security benefits. This is probably the most complicated piece in this section. Okay, and that is because Social Security benefits could be partially included in income. Most people believe that they are entirely excluded from income, and that's not really true. Now, the most of your Social Security benefits could be taxable as 85% are included in income. You always get to exclude 15% regardless of your income. But when you see the term Social Security benefits in any type of work you're doing, or you're talking to a client or whatever, you need to realize you cannot just look at the Social Security benefits and determine how much is taxable. I mean, you can maybe take a guess, but to know what it really is, what should be included in income, you have to calculate provisional income. There has to be this separate calculation. So you have to do this extra calculation to determine how much your Social Security benefits are included in income. So provisional income is defined on here on this next slide. You start with AGI, adjusted gross income, okay, without the Social Security benefits. Then you add some things here. And you can see there's some list here, most of which we haven't even talked about yet, and most of which you won't ever see because they're very rare, okay? The second one, tax-exempt interest. We talked about that. That's from state and local governments. That is the most likely adjustment for this provisional income calculation. That's going to be the one that you need to make sure you pay attention to, that because it's excluded from our income normally, but in this calculation, you got to put it back in just for the purposes of calculating your Social Security, the amount that should be included in income. Notice the last one is only 50% of Social Security benefits. Okay, just half. That's provisional income. Okay? Now, next slide says if that provisional income we now have calculated exceeds certain thresholds, and we'll give you thresholds in the next slide, 50% of the Social Security benefits are taxable. Okay? It could go, if you get over the next threshold, there's two thresholds for each, the two different filing statuses, if you will. Then it is to be 85%. So remember, that's the most, that's the maximum you could do. Okay? So here is the two limits. Married filing jointly starts at 32. So basically, if your income is under 32, married filing jointly, provisional income is under 32, none of your Social Security is included. Between 32 and 44, approximately half, okay? Or either half of the income that's over, or half of your Social Security benefits. You can't have more. It won't be more than half. If once you get over 44, okay, it starts to go up to 85. And you see there's a little different threshold, not that much different for the single head of household or qualifying widower. Notice that married filing jointly and qualifying widower are different in this instance. These limits have not changed in as long as I can remember doing taxes. So this is not something that's been adjusted for inflation for forever. So this is continued as your income is worth less and less. This is hurting those who are receiving Social Security more and more. Okay, because $32,000 is not by as much as it did 20 years ago. Right? And so that is a lot less income, if you will, than it was when this was established. So an example, we have an individual who's files a return as a qualifying widow. She received $7,000 of Social Security benefits. Half of that goes into provisional income, $19,000 of interest, and $5,000 of non-taxable municipal bond interest would not be included in a regular calculation except for calculating provisional income, which is $27,500, half of the Social Security benefits plus 19 plus 5. So she will either report Social Security benefits equal to lesser of the 50% of the benefits. The most would be $3,500, or 50% of the amount she went over the threshold. Well, she went over the threshold by 2,500. Half of that is 1,250. That's less than half of her benefit. So she uses the smaller of those two, 12,050. So remember, the good thing is it's half of the lower of the two, not half of the higher of the two. Some other things that need to be included in income that you might not think about. Jury duty pay, which is like $12.50 a day or some crazy number like that, which hardly means anything. But nevertheless, you're going to get a document that tells you that you were paid that, and if you don't report it, you're going to get a notice from the IRS. Prizes and awards are included in income. Okay, there are some very limited situations where your employer can give you a safety and award that is not included in income, but for the most part, prizes and awards. You go on a game show, you win, that's income. In fact, there's some pretty famous cases of people trying to get out of that or not reporting it after being famously on a game show. That's just not going to work. Forgiveness of debt. You owe a certain amount of money. You owe on your credit card. You get behind in your payments. You ask the credit card company for a reprieve. Okay, and they grant it. They reduce how much you owe. That is income. Seems fairly unfair, since it's not like you have money to pay the taxes on it, but it is still income nevertheless, except in, of course, as there always is, exceptions. And we'll actually dig into that a little bit in one of our research assignments. Insurance proceeds in excess of adjusted basis of property that you bought for $50,000 burns down. The insurance pays you $70,000. You've got actually a gain of $20,000. Okay, and then gambling winnings. Many people forget this. You will get a W-2G when you get a prize at a casino or anything over a certain amount. They will send it to you. But all your gambling winnings, you win the lottery, you're going to you need to report that. It's income, gross part of your gross income. Okay, review. All interest from state and local bonds is not taxable. That answer is technically false, but most of the time is true. Only a few instances where there is a private endeavor involved that it would not be taxable. It would be taxable. Okay, qualified dividend. Remember the difference between qualified and regular dividends. Qualified comes from domestic corporations out of their earnings and profits, and they have a different tax rate. They're still included in income, but they have different tax rates on that income than regular income. And you can have other types of dividends, right? Stock dividends, they're not income, but there's still a possibility that those exist. Review of provisional income one more time. Secura and Mason file a joint return. Their AGI before Social Security is 22A65. You add half of their Social Security benefits and the tax-exempt interest, and you get their provisional income. You see there the answer. That would then be compared to the thresholds to determine how much is actually included in income. But this question was just asking for their provisional income. And then some other incomes which you are reported on Schedule 1 of the 1040 as an attachment. And we talked about both of these: jury duty, gambling, winnings, both of which could be easily missed when preparing a tax return, but you don't want to do so. All right, that's our discussion of what's included. Part 2, we'll get into what is specifically excluded in the law.